love the channel and find it useful in becoming a happy retiree. Subscribe today. So we have a lot to talk about. Now there's still a lot to come as far as some of the more granular pieces of tax reform, but the heavy pieces of the equation are here. We've gone over these over the last several months because there were leaks about what this would look like, and there was an initial document a couple of months ago, but it was only a one-pager. Now, the Big Six issued a 9-page document called Tax Reform, Unified Framework for Fixing Our Broken Tax Code. And it is broken. And this is how they're going to fix it, with anywhere from how the brackets are going to change from 7 down to 3 and really 4, because there's a new pretty significant 0 tax bracket in this new proposal. Corporate taxes, of course, there was some compromise from what Trump wanted and had talked about. Those numbers now official, and I just heard a computer just log on for some reason, but good morning, welcome to Money Matters. Let's talk about what's happening with tax reform. So for you, this is the individual piece of this, and there are really two main parts, of course. You've got the individual tax reform that matters for you and your family, and then the corporate tax reform that matters for big companies. I would call it a third area, really, and that's the small business rate, which probably has, well, I would say has the biggest potential change. All of this is potential, by the way, because it has to get passed. All of this is potential, but the biggest change would come in small business ownership for a sliver of the population that has a lot to gain if this said tax reform actually goes through. Let's start out by the brackets. Of course, you've heard this already. 7 brackets go down to 3. Today, as the bracket stands, the low bracket, 10, and then 15, then this is today, 25, 28, 33, 35, 39.6. Don't ask me how we got to a 0.6 in our 70,000 page tax code. Actually, that's par for the course. So think of it this way. The top 3 brackets are going into 1. So think of 39, 6, 35, and 33. They merge into just one bracket at 35. Then 28 and 25 existing today, they merge into the 25 bracket, and then the 15 and the 10 bracket merge into the 12 bracket. So the new 3, 12% tax bracket, this is for personal, 25% tax bracket is the middle range, and then 35%. I would contend that there is a 0 tax bracket, because the 0 tax bracket is now created because of a much larger standard deduction. So if you have nothing to deduct, you've got no mortgage, no charity deductions, no write-offs for a home office, let's say. Even if you don't have that anymore, this new tax plan would give you a much higher standard deduction, meaning that if you're single, now the standard deduction goes up to $12,000 a year. If you're married, $24,000. That is a virtual double on what is now what is called the standard deduction. So technically, if you're a family, the first $24,000 you make because of the standard deduction is effectively 0 tax. The whole $24,000 gets written off or offset, and you don't have to pay tax on that. If you're single, the first $12,000 you make is technically at a 0 tax bracket. And that's a big change. And that's a really big part of this. I've heard lots of angst about the 10% bracket going up. So technically those 2 lower brackets, remember today's brackets, the lowest 2 today are 10 and 15. The new lowest bracket will be 12. Well, I've heard outcries, and I did a Facebook Live on this. It's on my Facebook page, where tons of questions this week about, well, wait a minute, what about my 10 going to 12? That may be the case. If you're in the 10% tax bracket, this new code says now your rate is higher. However, from what I can tell, your taxes might actually even go down. Even though the rate's a tiny bit higher from 10 to 12, you're going to get to exclude, if you're married, the first $24,000 completely, because that's effectively now at a 0% tax bracket. Now, and if you want to see that video as well about the whole tax code, you can go to my Facebook page at Wes Moss Money Matters, or my YouTube page, Wes Moss Money Matters. So now, if you think of it this way, if you're in a very high tax bracket, let's say it's $1 million a year is what you're making, and you're in the 39.6 bracket, that's going to go down to 35. So that's a 4.6% tax cut, or call it $46,000 less in taxes for really, really high income earners. Now, I doubt this is going to happen because there's already talk of a new fourth tax bracket that's even higher than this to prevent really high earners. And I don't know what that's going to be defined of or add. I don't know if Congress comes back and says, wait a minute, you shouldn't pay $46,000 less in taxes because you're making over $1 million. They may say for people that are from $500 to $1 million, they could make a new bracket, $10 million earners and above. I don't know what that number is going to be. But the first question you're probably thinking is, well, what are those numbers? What tax bracket or what income level do I need to get to or stay at to stay under the 25 bracket? The answer is they have not been released yet. There is no indication yet of what the exact income or adjusted gross income figures are that will, in fact, fit into these new 12 brackets or new 3 brackets. But I will tell you, as soon as we get that information, we'll do alerts updated on Facebook Live and, of course, here on Sunday mornings. What about, let's go to the next piece of this. From what the proposal would like to do is increase the child care tax credit. It's currently $1,000 per child if you're using, or $1,000 per child for child care. That looks as though that could get increased. Again, details still yet to come. But a brand new credit of $500 if you have a non-child dependent. So think about so many families that I work with over the years, they're taking care of their elderly parents as well. So many families, if you're in your 50s or 60s, very likely you're taking care of mom or dad or both mom and dad. Well, that's a big financial responsibility for you too. This new tax code would recognize that, and there'd be a new credit or tax credit if you're taking care of a non-child dependent, particularly elder. Which to me looks like it's designed for those taking care of elderly parents who are dependents as well. Now, so these are all lower taxes. That's great news, right? Over 10 years, this tax cut looks to be about $5.8 trillion with a T, $5.8 trillion. But remember, we've got to pay for it, meaning that we can't just have lower taxes. There have to be some offsets. And from what I have gleaned here, there's about $3.8 trillion of offsets. So we'd still have about a $2 trillion number that adds to the deficit. Well, here are some of the offsets. Number one offset, from what I can tell, gone, the state and local tax deduction that so many Americans get. That's also referred to as the SALT deduction, state and local tax deduction, that really hurts. So if you're in the state of Georgia, we pay a 6% state income tax. It's actually relatively low. Yes, there are a couple of states like Florida and Tennessee that don't have a state tax, but states like New York, New Jersey, California, those can get into the double digits. So it really hurts those individuals in those higher tax state-paying states. So think of it this way: if you have income of $500,000, and let's use Georgia as an example, you pay 6% in Georgia tax. That's about $30,000 a year. You would lose $30,000 worth of a deduction as well. So what would that cost you if you're paying about a third in taxes? That would cost you $9,000. That's the kind of offset that, even though we are getting potentially some lower numbers and lower percentages, you take away big deductions like that, it'll bring your taxes back to closer to where they were. But what about the corporate side? So we just talked through the individual side. Oh, by the way, deductions, we didn't talk about this. After the state and local tax deductions, those going away, that will cost you. So what you save because of the brackets will likely be somewhat offset by losing big deductions that most Americans take, or many Amerians. For instance, state and local tax deductions, that's going away. But the big deductions that so many of us count on, like the mortgage interest deduction or charitable deductions, those are slated to stay. So never fear mortgage and charitable deductions staying in this new tax proposal. Well, we knew the corporate rate was supposed to come down. Right now, the corporate tax rate in America, 35%, proposed now to go down to 20. Trump, for months and months, wanted it to go to 15. I think that's a great example of him being a tough negotiator, knowing that he probably wouldn't get to 15, but why not start down there, land at 20? And that's what maybe he wanted to do from the outset. The average corporate tax rate around the world is 22.5%. So this would put the United States at a slightly more favorable place tax-wise to do business than most places around the world. So I think that that's important. And therein lies the whole idea of how this ultimately gets paid for. Sure, we're getting rid of some major deductions, and that pays for, call it, 2/3 of the big tax cut. So let's round the tax cut off to about $6 trillion over 10 years. All the offsets, let's call that about $4 trillion to pay for it. Well, you still have a $2 trillion gap there. Where does that money come from? Well, it's got to come from growth. It's got to be greater economic activity, more robust growth here in the United States. That's the only way that this really gets paid for. Well, and how do we do that? Well, we take our relatively, I've been calling it Goldilocks because it hasn't been bad economic growth. It's just been kind of okay. It's been anemic, 1.9 to 2%. We've got to get back to the 3% growth that we saw for almost 50 years here in America, and effectively broke or stopped right around the time of the Great Recession. And it's never come back to the full 3.1 that we're used to. This is a way to get back there. Tax reform in America. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.